In today's video, we'll be discussing the stock market and the latest developments. Here's the current situation. At their recent meeting, the Federal Reserve raised interest rates by 0.25%. As a result, the Fed funds interest rate is now at 5%, which is at the upper end of the range. The Fed has updated its economic projections and expects interest rates to peak at 5.25%. This means that at their next meeting in May, the plan is to raise interest rates one last time by 0.25%, taking us from the current rate of 5% to 5.25%. After that, the Fed plans to maintain interest rates at 5.25% for the remainder of the year, which is at least 7 months. Investors in the stock market are doubtful about the Federal Reserve's plan. They don't believe that the Fed will follow through with their intended actions. The market is indicating that it's more probable that the Fed will not increase interest rates at their next meeting in May and instead maintain the current rate of 5%. Currently, the likelihood of the Fed pausing at 64%, while the probability of raising interest rates by 0.25% is at 36%. The Federal Reserve increased interest rates by 0.25% during their last FOMC meeting, which was in line with the market's expectation of a 65% chance of a rate hike. Despite the expected outcome, the stock market had a negative reaction and experienced a significant decline on that trading day, ending the day in the red. Consider the potential reaction of the stock market during the next Fed meeting if the outcome is worse than anticipated. For instance, if the market strongly believes that the Fed will not increase interest rates, but the Fed unexpectedly raises them, it could be disastrous for the market. As I previously mentioned, I provided a heads up before Fed's meeting regarding the expected outcome. I mentioned that the Fed would increase interest rates by 0.25%, and if they'd increased it by 0.5%, it would have been disastrous for the stock market and triggered circuit breakers. However, in the upcoming May meeting, if the market anticipates a pause but the Fed raises rates, it could potentially result in a significant market crash. In this case, the stock market is setting itself up for a bloodbath. It's important to note that the pain in the stock market may come sooner than expected due to a few reasons. By April 12th, the market will have a clearer picture of what the Federal Reserve will do at their upcoming May meeting, as the March inflation report is released on that day. It's crucial that this report shows significant progress in reducing inflation, with a CPI print of 5.7% or below. If the print's at 5.8%, it could lead to a bad day in the market. But if it's 5.9% or higher, it could be catastrophic, potentially leading to a market crash. This is because if the inflation rate is at 5.9% or higher, it'd mean that the Fed would need to raise interest rates by 0.25% at their next meeting in May, and the market would come to this realization with the higher inflation prints. It's crucial for the Federal Reserve to bring inflation down to 5.7% or lower in March, as this is the easier part. The real challenge will be meaningfully reducing inflation when it's in the 5% range, as this is when it becomes stickier and harder to control. Let's delve into the Fed pivot, as it has some perplexing aspects. The difference between what the Federal Reserve is announcing and what the market is expecting is quite striking. Here's the situation for the upcoming Federal Reserve meeting in June. The market anticipates a 55% chance that interest rates will remain at 5% and a 20% chance of a decrease to 4.75%. However, it's important to note that the Federal Reserve has indicated that interest rates will be at 5.25% come June. Additionally, the Federal Reserve plans to maintain interest rates at 5.25% throughout the remainder of the year, at least until December. This is the point where things become extremely interesting, and it's important for you to be aware of this. According to the market, the Fed pivot will begin by the July meeting, with a 100% chance that the Fed will cut interest rates by that time. On the other hand, by July, the Federal Reserve has signaled that interest rates will be at 5.25%, while the market is predicting interest rates to be at 5% with a 15% chance, 48% chance of 4.75%, 33% chance of 4.5%, a 4% chance of 4.25%. In other words, the market's not even considering the possibility that interest rates will be at 5.25% at that time. The difference between the market's expectation and what the Federal Reserve is indicating is enormous. The market's expecting a Fed pivot by June or at the latest by July, with a 100% probability of interest rate cuts. However, Powell has stated that a Fed pivot in 2023 is not in the base case scenario, and interest rate cuts are not likely. If the Federal Reserve fails to initiate interest rate cuts as expected, the stock market's at high risk of crashing. Hence, if the March inflation report does not indicate significant progress in lowering inflation, it would spell significant trouble for the stock market since the current expectations are highly optimistic. There's another scenario that could happen where the economy collapses or experiences a significant setback, and this would force the Federal Reserve to slow down and possibly pause or pivot sooner than they planned. This is a real possibility, especially considering what's happening in the banking sector, as even the bigger banks are feeling the impact. For instance, take a look at what's happening at the Deutsche Bank in Europe. In this scenario, a Federal Reserve pivot would not result in a market rally. Rather, it would be a response to a crisis that would likely be insufficient to avert a downturn. Historical data shows that bull markets do not typically start with a Federal Reserve pivot, but rather months after. It should be noted that the information I'm providing in this video is just facts, data, and not my opinion. However, if you'd like my personal opinion, I am happy to provide it. In my opinion, the Federal Reserve is facing a difficult decision with no easy options. On one side, there's the risk of hyperinflation, and on the other side, the risk of economic depression. The Fed will likely try to avoid both scenarios and choose the path of stagflation instead. This means that we may experience economic contraction along with elevated inflation, which is also known as stagflation. You'll likely hear this term more frequently in the media as it becomes a popular topic. I think the Fed and politicians may view stagflation as a better outcome than hyperinflation or economic depression. If the Federal Reserve wanted to halt inflation, they could either decrease the money supply or impose more stringent reserve requirements on banks. However, these measures would result in an economic depression, which is not a desirable outcome. Conversely, to prevent an economic collapse, the Federal Reserve could lower interest rates and increase money printing. But this would likely exacerbate inflation and bring us perilously close to hyperinflation. The Federal Reserve will opt for the least damaging option, which is stagflation. While it may not be as catastrophic as economic collapse or hyperinflation, it'll still be a painful experience for average Americans, especially those on fixed incomes like retirees or Social Security recipients. The lower income group will be the hardest hit. I predict that Jerome Powell and his colleagues will fight inflation as long as they can until the situation becomes unsustainable. I anticipate that the stock market will decline to at least 3,600 for the S&P 500, and from there I'll assess the severity of the situation. The stock market currently relies on overly optimistic expectations, which are likely to lead to a significant letdown. This is just my perspective. In the upcoming weeks, we'll see how Q1 corporate profits and margins fare. And I do not anticipate positive results. Furthermore, I predict that Q2 will be even worse, and this is in line with the consensus opinion. Currently, there are two things that I would suggest doing. Firstly, I would advise keeping a larger portion of your portfolio in cash to be prepared to take advantage of buying opportunities in case of a market crash. Secondly, I would recommend considering investing in gold or gold-silver-related investments, as the Federal Reserve's actions to address economic issues through printing more money could lead to increased inflation, which could benefit gold and silver due to its industrial uses. To summarize, the market expectations are too optimistic despite the fact that we're currently facing economic challenges. A Fed pivot may not be able to prevent a crash if something breaks, and indicators such as declining corporate profits, high PE ratios, increasing unemployment, and slowing GDP suggest that the economy may not be headed for a soft landing. However, if you have long-term investments, it's advisable to weather the storm and avoid panic selling. Nevertheless, it's recommended to hedge against the crash and maintain reserves to take advantage of fire sale prices when the time comes. The best time to buy is when the market's in turmoil. Please subscribe. Thanks for watching. Until next time.